Hi, how you all getting on out there? Tough old it's just set the chat up. So is there anybody joined us already? Where's Bletchley? He's normally out the blocks. Did you all end up winning on Friday? Hi there, Anonymous. How you getting on? It's quite boring today, isn't it? Not a lot going on, despite all the crazy outcomes in Europe. So I'm hoping to just run through a few things just to cement them in my own head. Just because all the media just keep talking about the non-farm payroll print being a big miss, and yet it's the only bit of data that really did miss, and half of the report was actually negative, like everything else. So all a bit crazy. And we'll look at that. It's just down to seasonal adjustments. All the data gets seasonally adjusted, but it's quite a weird one at this time of year. And there is an August rejig, just like CPI, if you remember back to January when they do their annual reconciliation to make sure that the numbers are all correct. They do the same in August for non-farm payrolls. But as I'll show you on the data, it hasn't really moved as much as what the estimate was. And yet the real numbers in the household report, the actual unemployment rate, the amount of people signed on to actually be in the labour force is dropping. And the number signing on, initial claims, etc., and continuing claims is going up. So that was reflective of all the weakness we saw elsewhere. So I'm quite surprised everyone is so wound up. But as we know at the moment, it takes a lot. Everyone is all over the place. It takes a bit of repetition to get them to believe you. So yeah, the dollar as a result has continued into its ABC pattern. We said we've had a number of opportunities for it to be finished. We had the first ABC, but that turns out to be the first three waves of a higher degree ABC, which itself we went to a new low. So this was a really complicated one to try and catch us out. Then the expanded flat, where you can have a terminal point beyond what the traditional ending point was, the previous wave one. So when you get an overthrow, that gives you an expanded flat, which means that the final wave will go beyond the first three waves of consolidation. So you've got an ABC. We're looking here to end around 105 and a half. The C waves always finish with five waves in them. So we look like we're three parts of the way there. Somewhere we've either done the third wave or we're just trying to top it out. Little pullback and then another jump up. Hello, Vivi. You're having fun in gold, I see. So the dollar obviously as normal dictating, and that's mainly on the pushback from the non-farm payrolls and the wage number as well itself, because the way that the holiday fell meant that um, there was a funny about 2 extra days worth of data falling into the report, or the denominator was smaller. I can't remember what they actually said, but it means it's a falsely positive jump in the average earnings as well. So really, I'm surprised there wasn't more commentary around saying that we could potentially ignore these numbers. Hello, Bletchley. And yes, we've got CPI on Wednesday, Anonymous. That is obviously before the Fed. They get it on the Tuesday, I think. Um, the the problem with it is that we just can't get it to break, can we, on the OER part of it? And some of the wider measures are just tickling along positively. So I'm hearing a lot of commentary from people. If it comes in at 0.2, then that might be considered bullish by the market. But anything above that on the core is going to be disaster time for the early rate cuts, given how the market seems to interpret it. the Fed's PCE has been okay, and all the other data points, including NFP, to me suggest that we're still eking towards nearer rate cuts. But it's not for us to play with what we want. It's how the market plays it. And at the moment, there is someone out there that is really pushing on the door on being hawkish in the setups. We made a lot of, but if you rein it in, we actually progressed on yields over the week. It's just that we pared back a little bit on Friday. So the whole narrative change of last week held. So it wouldn't take a lot just to get us back on. And it'll be classic that if you get a weak number in CPI, then people will say, oh, ignore the establishment part of non-farm payrolls and concentrate on the household bit. But we have to be aware of it. The other thing on Wednesday is also, it's obviously the FOMC at night. Powell has continued to be dovish in his assessment of the whole meeting, and that's mainly because he's got doves all around him that are voting. But they're all going to put in their dot plots. Now, surely no sane person is going to put their dot plot in until they see what CPI actually says and whether the rent side of it is improving or not. But the danger is that they move the dot plot from closer to 1 than 1.5, 2 for short-term sentiment, and that might be enough. If we've got this sell-off going in to tomorrow, that might be enough just to finish off the dollar thing. So I don't think it'll actually move that much either way. A lot of people are writing it off. The curveball for the dollar may well be if there's any excess problems from the US Treasury in terms of the federal budget. If they haven't been able to raise as much as they wanted, or they think they've got to raise more, that wouldn't be great. And if they suddenly feel that they've got to issue more at the longer end of the curve, there is a 10-year auction tomorrow on Tuesday. So we'll get a real sense of how all this data has left the bond market. You'd expect from the way it moved last week that people should be quite happy to participate in that auction. So it shouldn't be a bad message from that. But as ever, the market is a little bit skittish at the moment. So I'll go and look at the non-farm payroll in a minute, just on the actual data. Then there's gold, which I apologize, I should have been aware of what was coming out from the central banks, what timing, because on the World Gold Council, the figures were still a month behind. But you actually can go to the central bank websites and see. You can get to date. You can eventually get to data. It wasn't easy in the case of China, but I'll show you what I found and confirmed what people were saying. I don't like just relying on what the news services eventually came up with, because often they're wrong. Like just at the FOMC for the week, what would you, if you were putting it together, what would you be putting in as your dot plot estimate? And then we'll have a little chat about politics, because it can end up happening and having an effect. It never used to when I was first going through the markets. It had to be a real shock for it to cause anything. But at the moment, everyone's getting curveballed left, right, and centre with how things. And it's mainly not having clarity is the problem. And then we'll run through the charts. So Anonymous, yes, gold has dropped a lot, but remember we've been in. If you've been following what certainly I've been saying, we're in a wave 4 consolidation. We're expecting it. We're looking for 2250. Didn't know how the hell necessarily we were going to get there, but we seem not far away now. And it feels like the technical still has one more down leg in it of this final part. We'll have a look at that. And then that kind of China gave it the confirmation. We'd been talking about how the buyers didn't seem to be around just from the action and the prints that were going up. And so it proves, but that doesn't mean that they've finished. They haven't said they've finished. And this is only their central bank official reserve assets. They do buy a lot of gold in other ways and import gold in, etc. They've kept quiet in the whole lot. But the thing that I'd like everyone to consider is it the fact that they're not buying, they just don't want to chase it, or maybe there just wasn't supply? And I mentioned it a couple of weeks ago. It felt to me like they were trying to get the market short at a low level, so that when they do come in with their next buys, they can really move it. But they're also running into a lot of people who are thinking that the move's over, so they're trying to bluff some supply out of the market. Hello, Ian Wessels, you beauty. So yeah, let's have a look at the actual data over there. So I'll just have to come out of this share window. So first of all, on the CME, we talked on Friday about how over the week we had pushed in for September becoming more in favour. Just to confirm, if I get the mouse working. So we've got this week's, now it's almost 100%, there's nothing happening, we know that. And then July, still at less than 10%. That's not really moved since Friday. It's pushed out slightly, but obviously on the week, that's more than halved. Just so we've got a bit of momentum going at the start of last week. So July, it's almost, you could hear the door swinging closed. Whether it's completely gone on the latch for July, we'll find out tomorrow, won't we? But September still very much in there. It's almost a coin toss bias, slightly to just one cut, but we've got someone there looking for the 50 basis points. But that again has halved on the week. So we did well. We progressed pretty well, but there's just a tiny bit of pushback. November and beyond is still favourite for at least the first cut, and then by December you can see that it is really pushing out into the 2-cut territory. So none of it's really disappeared. It's just gone from suddenly 2 weeks ago we were no cuts and the hiking. Last week it's suddenly 2, are we doing 3? And now we're back to 1, 2. And it's just flip-flopping. The market's living on the data just like the Fed is. But we had the non-farm payroll, didn't we? Friday. So has that come through? Long-term institutional are still bullish on gold. Yes, long-term institution is. I think everybody's still relatively bullish. A little bit of short-term, thanks. But remember, you've got the people with the big shorts, JP Morgan and the Fed, etc., will take any advantage of smashing that down when they can. And perfect opportunity with the central banks not really doing anything. But long-term, yes. And yes, Mr. Wessels, long-term bullish. We're still in the middle part of the waves that are breaking out. And the next, once we've finally put this bottom in, the next stop is 25.50. That then consolidates probably back to around this range where we are now, and then goes again. The moves will get bigger, but overall, it is in the ascendancy. It's just about, it'll be healthy once we put in that 25.50 to come back to 2200, 2200, 2300 and consolidate there for a time, just to really, for the gold market itself and the miners, just to establish a base, a new base, rather than it being 1800 to 2000, being, that 10 to 20% higher up. That would be ideal. But I think we've still got to get through the last euphoric bit of this minor waves, the red waves that I have set up. Anyway, this is a household report. So when non-farm payrolls come out, I told you to go to BLS Gov before. And then when you go to employment situation on the day, you're presented with this whole list of things. You've got household and establishment. So the non-farm payroll, the one that missed, is table B. And the one that was bang in line with everyone else is table A, the household data. You always have to look at them both. I go on about it. Not enough people in the market look at both. They just listen to the media streams and the odd strategist. It's really healthy to just dive in to this report and have a look. So household data, you come in and you look at it, and then instantly what you see there is that the labour force, so when you're doing an unemployment rate, the labour force is the denominator. That fallen by 250. So people are actually leaving the workforce, and then the employed dropped by 400 as well, 400,000. So the denominator and the numerator are both dropping, which by definition meant that unemployment was going up. Some people do leave for different reasons, which are highlighted below, which is why there's a difference between 400 employed disappearing and unemployed only going up 157. But instantly, when you're used to looking at these numbers, you know that that means unemployment rate has gone up, as it did, and it's hit 4%. It's one of those rounding things. It isn't actually completely at 4 yet, but it's obviously in the area where it can round up. So you're thinking, that's bang in line. Why is everyone panicking? And it's and there's another nuance in the US figures that you have to sign on to be able to take a job. So you often get re-entrants to the unemployment arena in order for them to actually take a job. So that sometimes confuses. But that's the dangerous thing, that people, part-time workers, jumped up 400,000 for non-economic reasons. So it's people just having to go part-time. So that generally means people need a second job. So you've looked at that and you're thinking, yeah, that sits with all the other data of the week, getting worse. And then we go like, what on earth went on at the headline in the establishment data? So 165, that was remember these are say P when they're provisional. That P doesn't disappear until 2 months later. So that was 175 in April, that got revised down to 165. So there's a 100 jump there. The median was 185 and the whisper number on Friday was 168. So it came in 104 above the whisper number. And then you can try and go through all different sections of the economy where the jumps were. So it's in private service providing, there was estimated to be 56,000 more. Then you look, where are the other big numbers? So private education, health, care are big numbers for this month. They're normally big. And they were estimated to go down. These are seasonally adjusted at the global level. So they were estimated to go down. But then you go, right, they're still big numbers within the mix. Are they correct? So what you want to go and look at then is back into your tables, and you're looking for the table B, but with the non-seasonally adjusted in it. I think is that one. Yeah, right. So this takes you to all the different sectors, and you have the fourth column is the first 4 columns are non-seasonally adjusted, and then the next ones are the ones that have all the funny economist kind of predictions for where things should be. So we're looking for all that private sector stuff. So right, we're down here. So on the seasonal adjusted bit, that private education and health sector went up 86. On the seasonally adjusted factor, look, from 193 to 279. But if you actually look, the fourth column, which is the non-seasonally, just the actual amount of people employed in that area, went from 297 to 269, so it actually dropped, what, 28,000 people, and yet here they're telling you it went up 86. Doesn't sound correct, does it? And then healthcare and social assistance, that was supposedly went up 83.5. The actual number went up 1,000. So again, within here, we've got anything up to 130,000 of people supposedly estimated to be in the market, but they're not necessarily there. So if the Fed looks at that and they go, well, the household report said the unemployment rate went up, the number of employed went down massively, part-time went up, blah, 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 that all looks a bit naughty. And then they come in here and go, yeah, but it beat by 100,000. And if you're a dove, the first argument is, well, they're not real, they're estimates. Estimate numbers went up, the actual real numbers were nowhere near that. They were bang in line with really the whisper number, not even the median estimate. So I don't think that report was as hawkish as everybody is pointing out. So the Fed, who should be much more trained in this than I am, will be able to look at a data like that and go, well, it's an aberration and it's prone to revision. And I imagine there could be massive revision next month or the month after when that comes through. And again, that will sit with the August yearly reevaluation, won't it, that we talked about at the start. So don't put as much strength to Friday's non-farm payroll, because hopefully you can see, you have demonstrated there, that wasn't as strong as the media outlets are trying to portray it as. Right. Somewhere I have got the data for gold. Might have the problem of not being able to get it to show. Just hold, bear with me. Is that now showing? Let's have a look. Yeah, brilliant. So this is, if you go into the People's Bank of China. Hello, Julene, good to see you. If you actually go to the website of the People's Bank of China, just like you can go to any of the central banks, they'll all have a section on their reserve assets. And we know that gold is now second reserve asset, so you'll see big numbers. And this was gold's figures. So in terms of $100 million blocks, they had 1679 spot 57 in April. And then it came in at 1709 spot 6. So instantly thinking, oh, maybe they have been buying. But if you go back and look at what happened in May, gold actually moved by 1.5%, which brings you up to 1704 spot something. So literally about a third of a percent of the 1.8% it moved in holdings for China was down to the actual price of gold. So yes, people then looked at that and said, China haven't necessarily been buying, certainly not in their reserve asset account. That doesn't mean that China hasn't been the main purchaser of gold in other avenues. So, but it suits the narrative that we're talking about. It suits the actual technical setup that said it was going to come back, and we needed something to get the final throws in. We'd almost broken into an assessment that we may even have done that sloppy bottom, which we'll have another look at in a minute. It was, from my point of view, it was great to see that taken out on Friday. Wasn't great about the timing, because yet again, I couldn't get out at 23.80 on Friday, and it was 23.80 about 2 hours before I could get out again if I wanted to, which I don't necessarily, but it's just classic. If you try and trade global assets in UK time frame, nightmare. So that's where the real data comes from. Unfortunately, the World Gold Council, I don't know whether people pay to get some kind of actual figure release for May, but I couldn't find that on a free basis. I can only find commentary on it, so hence that's why I've gone to the actual websites, which is what I like to do anyway, and I encourage you to do it. Do your own work, trust your own analysis rather than what someone else has done. If you can't prove it, then if it goes wrong, who are you going to rely on? You have to own it yourself. And we're on our chat, that's how we do it. We own everything, don't we? If it goes wrong, it goes wrong. It's no one else's fault. So we've done the fundamentals on the China situation. We'll have a look at the technical in a minute. FOMC week, we kind of mentioned it earlier. So any thoughts from you guys? What you think people will do dot plot wise? or outlook. I mean, we've seen all that data. We've just shown that the only hawkish part of it is completely mixed. It may well be the most followed piece of data in the world, but it is prone to these things happening and getting corrected. So you have to bear that in mind. So I'm not completely convinced that everything's gone as back to being hawkish as what people are trying to make out. Remember, whenever you're watching the CNBC or Bloomberg, they tend to roll out the people that suit the last piece of data narrative. So today, all we've got hawkish people who are winding it all in. Last week, you could hardly get on the show if you were hawkish. But yeah, have it in mind. And as we've now seen over the last month, it's not just what we think and what we hear from Powell on the night. He's obviously keeps leaning towards being accommodative, being dovish, and then the minutes are written up in an absolute way, not in a defined who said what way for 5 years. So there are going to be sentences which don't fit with the narrative that Powell may come out with in the conference. We've seen that. And then that was attributed to all the pushback, which happened to be more a puke from the bond markets not actually wanting to keep paying top dollar for massive amounts of issuance. But that got twisted into being Kashkari. And even Kashkari was misquoted, as I showed when we delved into what he's actually been saying. It was just bringing it up, making sure it was in the minutes. But it was good because I managed to use him as mini-me, so that was lovely. So there'll obviously be a lot of chatter, but surely in those minutes, it's dominated by the speed of the deterioration of things, with a cautionary that, look, it may still be chugging along, but those aren't real numbers, and the real unemployment rate is now going the wrong way. You know, I think you've got to expect the minutes in 3 weeks' time to still reflect what was being said, what was being seen last week. And unless CPI puts a massively hawkish spanner in there tomorrow, and it's got to be in areas that do actually affect the PCE, then I don't think we really move away from September, November, December mix of there being 2 out of 3 cuts in those two. But that's just me being sensible. Political fallout. So I'm totally apolitical generally anyway, but I like to present what I see and what I see from the markets. Markets want certainty, so at the moment they're quite happy that what Labour have already said in the UK will follow through, and Rachel Reeves has tried to sound sensible. There's a lot of conjecture out there as to about the just how much has Starmer really turned away from being left-leaning. We'll see what happens when he gets in, if he gets in. Why do I say that? Because it looks absolutely nailed on. As it showed yesterday, and we keep seeing month after month, these elections aren't as nailed on as what people think. Hold on. Astro Gumbo, welcome. US dollar up, bonds up, stocks down. Is that what you're saying, or what do you mean by that? Because we'll talk about that when we go through the charts, but the dollar is just putting in extra little consolidation waves and is about to roll. It was rolling within those consolidation waves. We're getting an impulsive finish in a C wave. Bonds were back bid because of yield anticipation, yield going down, anticipation of rate cuts, which was cutting US dollar. You're not really going to see, I'd struggle to see people coming in for the bonds with the US dollar strong unless there was some form of improvement on the issuance side and a removal of the threat from central banks in going out of dollar reserves into physical reserves. And of the two that they've now got the choice of, they're obviously going hard with mixed news and so many estimations giving false numbers. I mean, July, I think there's still an outside chance of it. Obviously, the depends who you listen to as to how negative you get. Um, I think that, yeah, I think the Bank of England may have squeezed in a cut in June if it wasn't for that election call, which is it's going to be very difficult from an impartiality basis for them not to go. Again, that's part of this political fallout. Um, it wouldn't necessarily be helping the Tories because they're in a disaster zone, but there's been this pushback in euro for a long time. It was never a voted for fiscal union or monetary union, which is why Brexit appeared as being a want of the people, and many other countries are trying to demand it and never getting the chance. So they've reacted by moving their European parliamentary votes to the right, centre right, to far right in some cases. And that's never really gone away. And in the UK, there could be a curveball in this election because obviously Brexit won. Farage's party needed to move out of the way, or there'd have been a split coalition really when Johnson went to polls. But he did a deal with Farage for him to move out of the way as long as he enacted on all the ideas of Brexit. But they didn't really get any through because the centre left of the Tory party just turned it into a civil war, didn't they? So nothing ever got done. And I think what that's left is a lot of people that felt betrayed politically in the country, that they never got what they asked for. So there's half the Tory party that will probably jump ship and go to reform. But what no one's really talking about is the reason that Boris got in was the red wall. And it wasn't the red wall because they suddenly turned Tories. The fact that they were the Brexit voters too, and they were upset about that whole Brexit vote, etc., that had to go through the law courts, the legality stuff, and actually getting the Brexit deal done, etc., etc. So at no point has what everybody voted for in terms of Brexit ever been presented to the public or the country, regardless of what your beliefs are. Then that still sits out there with a lot of people. There could well be a number of Labour people that still want to vote for a Brexit solution party, which is what the reform would be. So I wouldn't rule out it being a lot lower majority for Labour than is currently priced in. Now, how would that work out in markets? Again, that gets you back to uncertainty, but it's uncertainty versus Labour's ability to be super radical with any crazy left-leaning, super left-leaning policies. So in a way, that would probably create a better setup for the UK market in the fact that you'll have a known winner, but you'll also have a credible opposition rather than an infighting one. So net, there'll be a lot of to and fro over the next month, but the end result should be okay for the pound. I don't think anything will come out of that will be deemed to be negative. So it gives us the opportunity to buy the extremes. And then, are there any questions on anything that I've spoken about there? Does anyone have any other topics to talk about before we look at it from a chart perspective? Anything that came out last week or today, anything coming up this week? We've got a lot of data for the UK this week with wages and earnings, unemployment rates, and then we've got, they were coming down, weren't they? The inflation rate, the average earnings rates were coming down, but not quite as much as everyone would like. But I think you take the bonuses out and it's beginning to trend properly. Then we've got GDP, industrial production, manufacturing production, construction numbers. So state of the economy a week before we have the UK CPI. We said there'd be another CPI the day before the vote next Thursday. So lots there for the UK to get their teeth into. Japan obviously has their meeting on Friday. Now, I think the market is probably looking for them to do, yeah, that's all. Tomorrow we have employment, etc., etc. Fine, yeah. I mean, please throw questions in as we go along. If there's anything that you don't understand first up, I'll go over it again. What we were saying there. Oh, Bank of Japan, yeah. It'd be nice to see some UK positives for sure. So Bank of Japan, I think the market has got itself in a position for expecting some maybe special small interest rate gift just to show that they're serious about the whole yen intervention fight. But if anything, the most likely consensus view is that they're just going to rein in their bond buying. Just looks like the market is looking after that in the auctions anyway, and it's finding the level we wanted around above 1%, which will encourage yield buyers. But I don't think UJ, etc., is going to react that well if there's no rate cut on Friday. So that will put them back into a position where we may see a breakout back towards 157.60 to really test them. But we'll look at that in a minute. It needs another high to finish the bullish pattern. Right then, so a number of you are playing gold, which has obviously dropped down into a new low on Friday, below 2300, 2286. That looks like a 5-waver is in place, which by now, with the way I look at things, Vivi, I'd have a lot of questions, but still couldn't get my head around them to even ask them. Just start with the easiest step. There's no dumb questions. So just ask. I have to go over a lot of these things myself to get my head around it. So it's just a case of building up the building blocks for why certain things connect to other things. So we've had 5 waves. By now, when I say what we're expecting next, then you should be saying at least a 3-wave of the same degree, but may split into smaller subwaves. So if you look at that, Ian, when you read the fundamentals on Forex Factory, what's a simple way to interpret the data? What do you mean? Let's kind of look at what I look at. Okay, we'll come back to gold again in a minute. We'll spend a bit of time on that. Bum, 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 bum. So Ian, where are we? Like I've not ever used data that is available on Forex Factory. So where do I start? So you go into an economic diary and say Wednesday. What they have set up is the furthest away column is the previous, and the middle column is forecast. And then when the data comes out, it's normally in the first column of 3. So like the things that have come out today. I'm just trying to find one that's useful. So GDP was positive in the 4th quarter in Japan, but it had fallen back to the preliminary report last time. So it was expected to pull back this time for Q1 to a negative print, and then that's what came out today. So that's bang in line. So you're looking really for market movements will be based on how it comes in versus forecast, not necessarily what happened last time. That becomes a factor when you look at it, just in terms of the trend or whether it's been revised. So on something like that, you go into it they'll have a chart to give you a sense of where things have been. Then it all depends on where it is. So the Q4, the final quarter was 2 prints ago. Since then, the first one comes out is a preliminary, so it's the first count for Q1 being January, February, March. And then they come in then a month later and give you a final print for Q1. So it's backward looking, it's 3 months away, but it all depends again on the forecast, what it is. We'll deal with one that's more real time to start with. So with these, you can get confused a little bit when you're looking at it. So it was flat for right. So when Q4 came in, its final read was 0.1, which was an improvement from the previous spot 7. But then each time some of these data points go through, they get revised. This is where you have to have a quick look at the data. So 0.1 there should have been 0.1 here, but that obviously, the next time they came out, that got revised down to being flat. Then it was forecast to fall, and then it actually fell even more. But then between the provision coming out and the next one, things actually aren't as bad as it seems, because rather than that being a negative 0.5, it actually was upgraded to being a 0.1, for which the second reading was then down. So there is a sort of dynamic lifespan to these, and it all becomes kind of reading between, like, this is a complicated one really, I shouldn't have started with this, but basically that means that you don't have to worry about Japanese GDP, because it actually was revised up and then it's a miss to actually a better number than thought. But the key thing is that you need to go in when these data come out, you need to come in and see exactly what's going on versus this middle column in the first instance. That will get you through most data points 80% of the time. So actual number, so you're asking questions, sorry. Actual forecast previous, real entry level. So the actual numbers are, it's like depending on what it is, it's some form of economic data for that country. So previous is the last month's actual number. So for the month, the current piece of data, lots of economists will beaver away and come up with their estimates. Then they get added up and you find a mean or a median to get consensus. Cool. And then obviously you get the actual against that. What catches us out is when there are some of these data actually have 1, 2, even 3 months sometimes revisions. So what might look super bad on the day can actually be a good number. And that's where the money can be made, because people just tend to focus on the headline, and you'll get the commentary, and most of the emails and links you've signed up for will hit you with the headlines. It's about being able to get under the hood quickly and see exactly what has happened. So obviously, yeah, gold is a dollar denominated instrument. So that is obviously very important for it, but it isn't always a 1-for-1 correlation inverse correlation between the dollar and gold. There's lots of other things. Geopolitical comes in, and obviously there's a lot of issues with settlements and this reserve currency status of gold now. So I don't know if you've been following us over the months, but the gold is now actually an official reserve currency at the global level with the Bank of International Settlement. So this is why people are selling out of dollar assets, which was the only thing you ever could hold as a reserve currency, into gold, for a number of reasons. One, obviously it's physical and difficult to be manipulated, and there's a massive shortage of it, and China's got most of it, and they've got 6 times gold in their country than what they've actually got showing in their reserves, at least 6 times, if not more. So the main data point we've got this week is CPI on Wednesday in the States. And then within CPI, you have core CPI, so that's X energy and X food in the main. And there's another thing which isn't in many of the diaries called a super core, which strips out some other bits, strips out the rent side of it to give you underlying data points based on mainly services in a way, which that's been the place that's been running hot. You can ask AI if you want and get an absolute load of gobbledygook. Try and ask AI who your favorite sports team's all-time 11 is, and you'll have loads of people playing in the wrong team, wrong position, blah blah blah. And I see AI stuff generated all the time. You can tell when it's AI, and it's utter nonsense. Very little depth to it. Often the wrong way around. I'm not confident AI is strong enough yet on the fundamental news to be accurate. It can tell you what's probably out on the day to look for. Which handsy cron you though? The honest one or the dodgy one? Smith's your man, surely. I love it. So yeah, so core CPI was spot 3 last time. Miss spot 3 this time. Remember, with all these things, it's all about the rounding. So that spot 3 has to be below spot 2.5 to go lower. So it all depends. I haven't had a chance to look yet. I need to get someone with Bloomberg that has 2 decimal places to tell me where it is. So that could be at spot 2.9, or could be at spot 3.4, and still come in at spot 3. Hello, Sean B. So there's headline numbers and there's movements, and then a lot of time you go, why is that happening? Because it's hit such and such. But it's actually because it's come in the wrong side. It's got away with it on the rounding, but blah blah blah. So people out there are saying that we really need to see a spot 2 for the market to be happy about the progression on inflation. Spot 3 at the moment, again, it depends which side of spot 3 it comes in at for how jittery people are. And anything spot 3, 5 and above that will be coming in as spot 4, and we'll have another big sell-off. That might be, that may well happen just to get these last legs in when we look at the charts. And if it's it all depends on the reasons why it's happening. So that's when we need to delve into the actual report, see which bits are moving, see whether there's an absolute funny. It just might be one heavy-weighted funny versus everything else being all right. CPI is everything in the mix. So this month, that's expected to be a beat on the month and in line on the yearly figure. So they must be expecting something to come through in energy or food this month. What's a pullback? It's probably eggs. Eggs seems to be the most volatile thing for this data series, you can believe. But a lot of the volatility is in motor insurance and airline tickets at the moment. So does that kind of make sense? And that's the kind of angle we're coming from, Ian. We're looking for how these things are constructed, what may or may not be in line or out of line with what the market's looking for at headline level. And then that's where the advantage is. If you can find the wrong move versus what's actually being printed, and that's when you've got a chance, which is why I'm saying I think this week is set up on the back of an erroneous non-farm payroll read-through that could very easily be explained away. And if we get a decent CPI number, then it'll be all things back on for the breakout. Cool. It must be your end, Sean. So I think this is working today. I've finally got it working today. So right, let's go look at some charts again. So, as I said, gold, we're expecting a 3-wave bounce off last week's low. And so far, we've kind of put that in. We've had a subwave move to this high, the retest, which happened this morning when we're all trying to catch the knife that we're playing. And then we have finally had a bit of breakout. Now, that has hit the equal legs of the first move up, the retrace, and then the second bit, we're into that 1.236, 1.618 is really where I'd be expecting this to fall. We should be putting in now some kind of little connector before we go again, because I think it's you, Ian, who has the same idea that I have. If you're looking at the retrace of the whole move down from last week's high, which is still within this channel, then anywhere between spot 382 and spot 618 would be the ideal place for the overall connector. So this means at a higher, this could be a three wave at the high degree, but within it there's going to be little sub waves. So I'd like to see a tiny three wave move somewhere in here that just consolidates. Then we go again with a sub wave, five wave that finishes off this red B, this minuet wave B. Sorry, subminuet wave. And then we'll get the final, what will be a high degree, five waves down towards 2250 is the way that I'm looking at that. Which was the original idea. So let's just want to go out on that. So remember last week when we were looking at all this, we had the five waves down, which was valid. We had what we thought was a three wave connector, and then we eked out what I thought was a very unsatisfactory set of five waves here. And I didn't like that as being the whole finish, because that's what we thought might be a C wave was only spot 36% of that first big impulsive move down. So yes, it had a low low. Yes, any number, if it's a low, is valid, but that's quite rare for that to be a zigzag. You'd normally be a 61% plus, which would have taken us down ultimately to where we ended up on Friday. So we had the breakout. I said it was beginning to look valid. And then we had the whole unwind of non-farm payrolls. As that happened, I think when I was still here, we talked about it needed to go to a new low now to invalidate the last Monday as being the low for the structure. And that obviously happened as I was getting in the car to go to Bristol. And when I looked at that later on, that kind of confirmed it, which is why we ended up putting in five waves down. Five waves down is another zigzag, which should be, I mean, there's one argument that could be made is that that could still be an A with a complicated B, and five waves down would be a much better finish. But again, I think that's low probability. Just because the time scale of it, I think we're going to do a three wave and keep this as a WXY. I think it is waves within waves, but we have now got another valid low, which is last Friday's low. But I've got that as kind of second place. I think we're sticking to this first retrace into the 2330s, and then one more final clean wave down, and then we should be done. And with the way the mood is and the data coming up, that kind of sits with me. Yeah, we'll keep trying to help you along, Vivi, with that. It is complicated when it starts going into multiple waves within waves. But the general idea is that you're looking for an impulse down, a consolidation, and then a final impulse to finish, which is what I talk about when I want the sort of clean structure to it. And that is why, from what I've just said there will be some people who interpret that Friday low as being a potential stopping point. And that's much, to me, that's much cleaner than that horrible one we had last Monday. That one over there, wasn't it? Which is why, I'd give that a much higher potential than last week's setup. So any other ideas on how gold's going to play out from anyone else? But yeah, it's kind of playing out on all the fibs, and the ultimate range, if we believe that is WXY joined up from the previous all-time high, that is what is projecting 2250 area still for crossing the downtrend channel. I've said many times, gold does trend very technically, and it does trend very well for Elliott wave theory, which is why particularly I wanted to use it when I came into doing this. I think gold is quite a good teaching instrument for wave theory. So many of the things turn out in classic structures. So far that is, and we should have been brave enough to stick with the original idea when I said that was rubbish. Obviously, when you see breakouts like that, the belief, even someone like me who still thinks it's likely, you're quite disbelieving sometimes that it can still do it. We said it, I did say it's going to sell off up here. I was expecting us to put in a connector before we got the non-farm payrolls. I was expecting this move down to 50, 60 bounce and then see how we reacted with non-farm. And I'd said I expected that to potentially, the market was set up too bullishly. So we had the fundamental background right. We had the technicals nearly right, but that caught us all out. And I didn't really expect the China data to be taken as aggressively as it was. But sometimes this is why we say technicals often lead the picture. The technicals have been telling us that it has to have a cathartic sell-off. And I do think, by the way, we're more than likely to do a big V shape when we get down here. The chances of getting a big buy in there will probably be slim. We'll have to make sure we're really watching it. But yeah, like I said, this is just my favorite method, and I just like to use Elliott wave because of its sentiment side of things. There's wave personality, which is something I'll go over in the next few weeks when we're talking about individual waves. But you can tell that's when MACD and things become important. So you start when you marry up RSI and MACD turning points and looking for the divergence between the peaks and troughs of those indicators. That gives you some powerful signaling for when sentiment is changing. So all starts to join up. It's building up those confluences and the reasoning why. But again, I'd say I don't put any off. The more confluences you can get, the way you look at the markets and overlay lots and lots of things, that is where the power comes from. This to me just there's a good map and tells us what wood we're in, and then we can start identifying the trees. So indices wise, the Dow, that's been the least impulsive of the bounce backs because it hasn't put in a new high. We were looking for a connector maybe, or while it builds up to breaking out. That's another one of these where look, you've got lots of overlapping, but we have got kind of almost a set of 5 overlapping 3 waves. That gives you an initial confidence, and you can see that it's a diagonal with looking at the trend lines between. And so the favored outlook for that at the moment is that we've put in a leading diagonal, which is a wave 1. It's bouncing off that, what we think was a turning point, a wave 4. So this means we're in an overall wave 5 with the double brackets, the way we've got it labeled, minute waves. So we'd expect 5 waves of the blue single brackets to make up this 5th wave, which we'll put in the red, the next high degree red wave. So it's very important. What does that all mean? It means that low there that we had on the 30th of May needs to hold, or we've got a different structure, that in which case we're going in for the double correction. At the moment, we're kind of halfway through. This is what I was building it to last week. So because there's lots of 3 waves in there, then it has the potential to flip-flop between a leading diagonal or just an extension wave in between. We can't really tell until we see where it progresses next. We look like we're consolidating at the very least if we're going higher, because we're breaking out of the trend channel. So where would equal legs be? So the first move down, consolidation, and where would that end up being? That brings 37,100 into play, which feels like that's a definite buy. If we get down there, that's the three-wave correction to finish that 4, at which point we'll have a decent bounce. If it holds, if this holds and starts rallying, then we should be going up towards a new high. Boom, boom, boom. Interesting that some of you can hear and some can't. I mean, we are open on YouTube and we're open on Riverside, so it should be coming through. Boom, boom, boom. So you're okay with the Dow idea? Loud and clear, Uncle Planty. Good old Davo. So on the S&P, that one again, this is interesting. You could say that it has finished with a wave 5. Some people are trying to call the top again, but it looks better so far as a wave 3 with an incompleted, one more wave to come. But we'll look at that at the lower degree. And while we're on this page, S&P here, from what could be the fall low, we're in the 5th wave up. The subwaves look like they're incomplete to me. So I think there's more breakout. But again, we're in a strange situation with the markets at the moment. Low volume into highs. Some people question it, but the underlying data in the S&P is right in the middle. It's not overbought, not oversold. We're at sort of 50% above their 50-day moving average. The 200-day moving average isn't at massive extremes either way. So that to me feels like we're incomplete, and the incomplete structure at the moment is to finish off the breakout 5th wave. It's just all about where we are in the subwaves. So looking at that, I said at the hourly level, feels like there's a 1 in place, a 2. We are holding on and have been for a while to the lower end of the uptrend. We've put in a 3-wave consolidator. That channel is probably done because it's broken out, in which case we've had a 1 with a consolidation. We've had another breakout. Here, are we consolidating? Have we done completely with a very tiny new top? Or is that just all part of the nesting situation to carry on breaking out? Obviously, depending on how you play, you can have a stop loss either way there as a sell or a buy for breakout. Nasdaq, that feels a little bit stronger, but again, that has put in probably a valid 5 waves. The wave 4 was quite strong there. But again, where that wave 4 low was last week at 18,926, that needs to break in order for this to be properly consolidating, in which case we're looking for spot 382 to spot 618, again 18,700-ish. If that's going to continue pulling back, if not, we've got another high coming. And on this trend channel, I've mentioned it a number of times, has been super strong. The blue channel, that is suggesting this whole set of 5-minute waves here to make the red 5 of 5 of a 3rd wave up of a proper. This is high degree levels of primary and intermediate level waves. That's a cycle wave, and then it's super cycle above that. Once we get this completion, and you've got all the people talking about, we're at all-time highs, end of multi-generational moves. When you get a pullback from that, and you're looking for a wave 4 is a 23 spot 6, 38% on average. It's a quarter of a massive move. If we look at that in terms of So starting from down here, 14,000 all the way up to 20,000, you're then talking about 25% of a 6,000 move. That's 1,500 points you're looking for just to be an inline kind of consolidation move. So probably more, it's going to grind up. I don't think at the moment we're in a position where it's going to pull back too far relative to where we are. It's maybe 1 to 2% max if we turn out that we're in a continued pullback. Gold. So the dollar, situation. Remember, we'd put in the 1 when we were talking about the Del Boy one more turn. And one more turn was going to be whatever this consolidation period was going to be. We've had an opportunity with an ABC to the 30th of May top, but that didn't hold. We went to a newer low in pretty much a standard double. So you had an ABC low waves there, an ABC up. So 2 lots of 3 waves, and then a 5-wave sell-off there. That's a classic high degree ABC. And because that is gone in that structure, it's gone to a lower low. It's gone beyond the classic 1 ending that we had in place previously. That's the expanded flat. What does that mean? That means, well, if we've got to put a 3rd leg in, because we've got an A and a B, we now need a C. The C's are going to be a 5 waves, and that needs to go to a new high for the whole move. You always get this overthrow at both ends. Again, just like how the hell did gold come off? We're thinking that's going to be a serious move. We had a massive jump, didn't we, on non-farm payrolls. So I think we've put in a 3, and we're at the moment just tracing out a little bit of dollar weakness. Could be anywhere within where we are now to 104.5, and then 1 final wave move up, 105.5-ish, maybe top, and then we should be hopefully back on track with the dollar weakness. At the very least, once we put in the ABC, there will be some form of selling off. Nikkei 225. We've got another, just like we played that diagonal before. If we're nesting in 1, we've done a 1 and a 2, and now we're looking for a 1 breakout of a lower degree. We've had 5 waves within that, again, in a leading diagonal overlapping nature. Just like we were patient before, when we could buy this with using the trend line as a stop loss probably. We may want to be just patient, see how the indices work out at the moment. We're looking to buy the proper 3-wave double connector back down here, 38, 200, 300, and then we're into a third of a third of a third, proper breaking out daddy boy that we like to look for. So this is shaping up to be in a good position. Will that sit nicely with a surprise from the bodge at the end of the week? Could be. Oil, again, not even going to change from the idea. We're going sideways. We might have 1 more low before a reasonable 5 to 10 cent rally, but just don't like it, and that can change on the drop of a hat. I'd rather stay away from oil at the moment until we get a little bit more extreme either way. Still mid-range. And we'll look at the DAX instead. So it's another one that's similar. I know Edward was playing around up here, and I'd said we'd put in what looked like a connector, and that we needed to have a final wave down. I was convinced this was WXY. So in fact, we've put in an A, we've put in a B. We look like we're very much in the last of 5 waves. So it's either done. No, we're going to have a lower degree 3-wave within that, and then the final. It looks like we've put in the A and the B within that. So we're looking for 5 subwaves down from here, back down towards that trend channel. So 18, 300 looks like a strong buy area for the DAX. So just be careful buying too early. We've still got another percent potentially to pull back there. Dollar yen on the daily basis, we still haven't put in a new high. We're trying to move up towards that. Had a couple of consolidations within this whole move. This could be a wave 5, in which case it makes sense that we've got a lot of overlapping. Could be an ending diagonal which suddenly blasts to a new high. But I'm slightly concerned about the relative waves in that. So this will probably, if that happens, need to have a number of subwaves to make that happen, just to make the middle wave not the shortest. It's another rule. The middle wave of 5 can't be the shortest. So again, that is a powerful thing when you can spot an impulsing situation and you know that this last wave is going to be bigger and the first wave is going to be bigger than the one in the middle, then you know that that's part of a subwave 5 to make a third, and you've got another couple of highs at least to come. So obviously the fundamentals on UJ are very, very binomial relative to what they do and what the Fed does. But if we drop down to the lower level, on the hourly basis, so there you go. So I've drawn it as being overlapping 4 waves. And within there, you'll start to see that there's a higher high that's not labeled as a high. That's part of the consolidation. So that's 3 down, 3 up, and then 5 down. So that is a classic ABC structure for a consolidation wave, and that is an expanded flat. Hopefully you're identifying that because it's a higher high, and it also then had a lower low within it to finish. Then you counter trend up for 3 swings, and now we're into 5 waves down, which that did 1, 2, 3, 4, 5. So over through the trend channel and back into it. So again, that looks very much like we are nesting, but this could be a set of 5 of a 5th wave. That means these can overlap. So the pullback in UJ, when it sits with all fundamentals, can easily be coming back here to 155 and also breaking out through that intervention level 158 before they potentially jump back in again. So that kind of is playing out. Once that's in place, we may get another attempt at the intervention from that high that brings us, as we discussed on Friday, back down to 152 and beyond. We need some fundamentals for that. Hello, Mohammed Tayab. I unfortunately don't have any control. I'd be dishing out discounts left, right, and centre, but I haven't got the power to do that at the moment. So you need Alex. Alex is your man on public chat. FTSE from the high in May very much looks like we're doing ABCs all over the place. 3 waves with 3 waves inside, so it looks like a WXY. That's what happens when you get the double corrections, and it very much looks like we've had so much sideways impulse, sideways consolidation moves and little impulses down. Looks like we're very much in the latter part of the C wave here. 5 little sub-minuet waves to come. We've probably burnt 1 and 2. We're in the 3rd one. So it should, if it happens, it's happening quickly and get into this range where hopefully a lot of them are bouncing from. Hello from sunny Amersham. Send it over, will you? Because it's raining and I've got to do a dog walk. Not good. Not good. But it is improving the hay fever because I'd have been like Timmy the Sprudel. Otherwise, couldn't open my eyes. They're so sore from the pollen. Very high pollen day. So yeah, FTSE, and that's really lining up with what I've been hoping to get. I want to buy this down here. 8,000 mega opportunity if we can get this last leg in. It's still a decent buy medium term, even if you go in here, but it's mid-range on the hourly basis to me. But again, because that is a 3 wave down to the W, the next next best probability is that that W low is a line in the sand, in which case, even though this looks ugly as a starting 5, you could probably find a way, and then in which case the consolidation has to hold the W low. So see how it reacts there. You could have a buy at the moment with that as a stop loss. But if it breaks, I think we're doing the 5 waves down. Nothing really happening from VIX and move, apart from if everything was going to the dogs again, you'd expect this to be back up here, 1920. It may well happen if we get a bad setup on Wednesday. Look out for that. But at the moment, as we said, we just seem to be range trading in what is pretty much the sort of line in the sand between fear and greed. We're in middle ground, I'm afraid, folks. It's very difficult to paint it any other way. All the sub indicators are saying it's not overbought, it's not oversold. Again, Edward was chatting, and I said I agreed with him because the setup I had was that the euro US dollar was going to have was shaping up more to be expanded flat than breakout. Again, that was confirming it, the low of the original move down. That has actually had a 3-wave connector up at a higher finishing point than the previous one high. So you're thinking that's bringing expanded flat in. That needs now a C wave of 5 waves. Had a 1. Looks like another expanded flat in there for a 2. A big 3 consolidation and a final 5. That's where we were looking for. Got to its absolute end point. Hopefully we're now going to have a bounce, but it's all about the dollar strength, isn't it, at the minute? This to me is sort of suggesting that dollar weakness isn't a million miles away. We know about the euro pushback. They're not doing anything until we know what the dollar's doing. But looks like the euro dollar is set up right on the cusp of some relief. And we're still, that will only be a 1-2 setup, which leaves us with the breakout 3-4-5. I still think we hit 110 a couple of times to put in what will be the first of 5 red up eventually. But within this, we're going to have a decent sell-off at some point when the dollar really sets up. When the dollar sets sail into its pullback. Ian Wessels with a Planty star. I hope that's me star. Silver, again, we talked about it on Friday. It's now gone into, this tells you why, that again, why gold is probably doing the double as well. This put in a 3-wave. We bounced off the bottom of that fair value gap. We've put in only a 3-wave on the daily basis and sold off again to new lows. So that to me looks like a double. And that is, let's adjust that to Friday's low. So yeah, so that means I think this 4 probably comes down here to low 28s. Another, just like the FTSE, absolute outstanding opportunity to buy silver down there. If it gets there, we're all in. And that more or less ties it up for me, unless there are any other questions. I think we've covered most of what I wanted to look at. Any fundamentals or questions on my technicals or anything that you'd add that you think really stands out as an opportunity? Anything for me to look at for later in the week? And I'm not around much tomorrow. Well, I won't be around tomorrow because I'll be doing some filming in London, so I won't be on the chat much. I'll be back Wednesday. Anonymous, you're too kind. Thank you. Appreciate the comments. So as always, be kind to everybody. Be sensible. If you're on a losing run, regroup, have a look at what you're doing. Are you sticking to your plan? Is your staking right? Are we too close to daily drawdown and we're going to blow our accounts? Just walk away, breathe differently, go and do some research, go and read, go and have a walk, watch a film, go and be nice to someone, go and ring your parents, blah, blah, blah. Be careful out there. It's all a game at the end of the day. We're just trying to get a little bit better than the next person. Hopefully we've got a tiny bit of edge. We know where we're going in the main. Let's pick off things in between that. Stop losses are there for a reason. We're not meant to win every trade, but we want to be set up in the right way with protection. And then we should win over the longer term. And it's a grind. And then sometimes we're going to have runs where we knock it out of the park. Don't get too forlorn. If you're on a losing run, it will turn if you're doing the right things. And if you're not doing that, then it's time to have a think about what the strategy is. Is that right? Is the staking right? Is your lifestyle right? Are you getting enough breaks? Are you keeping fit and well? Has everyone hit the gym today while it's super quiet? Have you gone for a walk? If you've got a dog, get it out there. But if there's no other questions, I will wrap that up, and I'll at least be back on Friday, if not something before. Thank you all for attending, and we'll speak soon. Bye.